Good afternoon, everybody. Welcome to today's session of Market Structure Matters. I'm Jesse Forster, Head of Equity Market Structure Research at Coalition Greenwich. Thank you for being with us today. Please settle in. This is going to be a really good one. Our guests today really need no introduction. Three of some of the sharpest minds in equity market structure here today. We have Met Kanak, Global Head of Equity Trading at T. Rowe Price, Mike Masoni, Head of North American Market Structure at Citigroup Capital Markets, Adrian Griffiths, Head of Market Structure at Memex. We're here for a free-form discussion on the proposals and a path forward. Guys, thank you so much for being here today. I want to dive in. There's a lot of consternation out there right now. Really, the vibe is unlike anything I felt in 20 years of market structure. Buy-side, sell-side exchanges pretty well aligned in opposition, at least to the process here. And that actually does worry. I think we should be focusing on some areas in the alignment of support. Because as the three of us have discussed, there are some areas where folks could reasonably agree and possibly even get behind. And we know this because the industry has been calling for some of those things. So if it's okay, I'd like to start there. Mike, something that we've talked about, from your view, where's sort of the best places to start? Where's the low-hanging fruit around the commonality here?
Well, thanks, Jesse. I appreciate you having me on here. Look, there is, as you said, a lot of consternation is kind of a nice way of saying it. But the reaction to these proposals has certainly been, pretty uniformly negative. As you mentioned, I think a lot of it has to do with process. This is an industry that is self-regulatory by nature and is used to, there's a lot of good minds in this industry, a lot of people who are really, focused on doing what's right, not only for their firm's particular business model, but for the industry more broadly. And I think, unfortunately, a lot of their opinions collectively have been excluded from a process that has gone, straight to a proposal stage as opposed to, following a playbook that the previous SEC administrations have certainly followed, whether it be in the form of concept releases issued to solicit broad, views on major topics, major overhauls, or more, targeted public roundtables. Typically the industry has been offered an opportunity to provide input at an earlier stage, but that's not where we are. So, many of us are weighing here the ideal versus the reality. And so as as all of us got this wonderful holiday gift dropped on our laps, right? But it's a week or so, 2 weeks before the holidays, as we're going through the 1,600 pages, I tried putting on my most rose-colored glasses and finding areas of, as you said, low-hanging fruit or things that we might get behind. There's not a lot of them. But, certainly if you look at what the SEC's goals are, they seem focused on increasing transparency, promoting competition, to an extent reducing systemic risk, and hopefully through more competition, ultimately creating more efficiencies in the marketplace. These are sort of mom and apple pie things that, as an industry, I think we ought to be behind. We may disagree with the means by which they're going about to accomplish these things, but the goals themselves, I think, are worth exploring. So in the vein of increasing transparency, most of us who've looked at Rule 605 for some time have agreed that there are areas for improvement there. So certainly that one of the four proposals seems to be the least objectionable. There are other areas where the industry has collectively gotten behind. We had a whole a year-long debate around access fees back in 2018 when the SEC posed its transaction fee pilot. So the concept of reducing access fees is not something that we've objected to necessarily in the past. How they're going about it here is a separate story, but the concept of reducing access fees, the idea of accelerating some changes to the round lot definitions, that again, that was 2020's debate through the market data infrastructure rule. So that one seems to be relatively low-hanging fruit. I like this idea of taking a look at fees and rebates and having a better sense of what they are at time of trade as opposed to end of month, maybe even looking at pricing tiers more broadly. And then lastly, I would just say the idea of promoting competition is a tough one to object to. This is a highly competitive marketplace. for retail orders, I don't think there's a more competitive market in the world, and I find it interesting that the SEC is choosing to really, point its guns at this particular area when there are a lot of other areas of our markets that are less transparent and less competitive. But again, here's where we are. So the idea of promoting competition is something that our industry is used to and would love to see, firms and people being able to innovate and do things without necessarily having the shackles of a pre-prescribed, method that the SEC poses put upon us. So let me just stop there. Let some of the other panelists have some thoughts on this.
I feel like Matt has a thought. He's been nodding in the background.
Yeah, it's going to be more nodding than talking because, as you can hear, I'm losing my voice. But I agree with a lot of what Mike just kind of went through. He said year-long debate around access fees. I mean, God, I've been talking access fees since about 2009, so it's been about a decade-long debate on access fees. But I think when we look at the proposal, there's definitely certain areas of it that institutions have been kind of advocating for change. The biggest one for us being the one-size-fits-all approach that we've obviously, had in our markets for the better part of, I guess, forever, and trying to deviate away from that and recognize that obviously not all securities trade similarly, and we wanted to adjust that both on ticks, on round lots, on access fees, on whatever else it might be. Even, I think some people have been open-minded about repealing UTP for less liquid securities, treating things differently because they don't all trade similarly. I look at these proposals, some of it is getting addressed that way, obviously. We are looking at, different ticks, obviously for what is considered more liquid securities or tick constrained securities. We're looking at reducing the access fee into different buckets, although there's less diversity there than I think people had anticipated. Round lot reform is something that, whether you like it or not, and I have to say it that way because obviously I wasn't a fan of the new round lot proposal and certainly protecting the new round lot sizes. It's been approved. It's been upheld in the courts. It's something that's going to happen, and it should help kind of at least differentiate the one-size-fits-all approach. So there are definitely things that I think we could be supportive of. I think the approach taken by the SEC, which, again, if you're addressing a specific issue like access fees, that's one thing. And we can kind of get around that from an industry perspective to say, what are you trying to solve for? Here, we've been told a lot of reasons as to why these proposals make sense collectively, but I'm not sure they're actually addressing a known problem. It's more like, hey, we had an issue happen in early 2021. We're going to try and maybe provide a retail experience that's not concentrated amongst the wholesalers. How do we do that? I mean, that's an insane implementation. It lacks a lot of practicality. In theory, I understand it to some degree, but it's missing so much of what's really important for it to be implemented in a proper way. And so the three things I think, we look for when we look at the proposal is, first of all, why, which I still haven't got a really good answer on that. But more importantly, you're looking at measurability of these proposals. So going back to the access fee that Mike highlighted, one of the questions we kept getting on that when we were on MSAC and we had proposed the access fee pilot was, how do you measure success? How do you know that what you've implemented has actually worked, that it's made the markets more efficient? And I would throw that right back to the SEC on these proposals and say, how do you measure success? What are we looking at? What are the numbers there? And I've yet to see that from them. So again, things we can get behind. I just don't like the implementation.
Sure. Thank you. I think those are great points. Adrian, I don't want to leave you out of this part of the conversation. From an exchange view, I guess, what's your thoughts here?
Look, not to pile on too much here, but I think, Mike and Matt really covered this pretty well. From a high level, the goals that the SEC is pursuing are reasonable goals. And even the topics are ones that are, have been debated for many years and should be debated and we should have some sort of resolution on. There are a couple things that I agree are low hanging fruit. Ground lot reform is something that we've been pushing for. We put out a lot of data showing how, round lot reform could actually improve execution outcomes. I think that's a good, thing for the SEC to do. 605, again, we recommended some changes in this area, and I think, using transparency to actually engender additional competition is a really good way to go about doing regulation. But, as it relates to many of the other proposals, I think the real question is, what are you balancing, right? There's a reason why we spend all this time debating these market structure topics, and the reason is you need to be balancing multiple different factors, right? If you want to solve, spreads from a round lot perspective and not balance that against anything else, the result is you protect one share round lot. But obviously that's not the right answer, because you need to balance that against liquidity. It's a similar set of problems for, tick size and other topics where, you really, what we all care about is making sure that you strike the right balance. And so I think we're all happy to discuss the topics, and have a debate, but also I think the SEC needs to think more about striking the right balance on these topics.
So what is that balance, I guess, and what would you guys suggest then for, around the tick sizes and the access fees? I guess, what's your recommendation?
Yeah, well, for tick size, this one's easy, because our recommendation has been out there for quite some time. I mean, we put out 2 white papers on this. I do think, look, half of US equities volume is taking place in these tick constraint names, and that is something that we should absolutely do something about. Now, nothing in the SEC's release or really any data that we have available to us tells us how much narrower can you go. I think starting with a half penny increment would allow you to remove those tick constraints. We'd get a lot of benefit in terms of reducing spread. We see those names trade with a huge amount of liquidity. So frankly, from a liquidity perspective, if anything, what you're looking at is you're making it easier for institutions to participate passively in the market, because you're not sitting behind, like a $1 million notional queue when you want to post. And we can do that and then evaluate how that goes, right? So, if the SEC puts in a half penny increment and finds that a lot of these names are still tick constrained at that increment, then let's have a conversation about, doing a quarter or something like that. But let's actually get some data first. I think similarly, from a liquidity perspective, if the SEC wants to do a half penny and then for tick constraint names, and then assess whether the cutoff for that is wrong, at least we'd have some data to evaluate the trade-offs between spread and liquidity, and then we can make a more meaningful change there. I think that's really what we want the SEC to do. And I will say, we've looked at what the SEC's proposed. Most of the benefit that I think the SEC doesn't actually kind of come out and say, like, here's a number, here's how much we think people will save from reduced spreads in these names. I think if you look at the volume in the different buckets, tick constrained names are about a quarter of the symbols. They account for most of the volume and notional that's being potentially subjected to a lower increment. And if you think about this, that actually means that most of, even if you assume that there's some benefit in other symbols, most of the benefit's actually going to come from the tick constraint names, right? You could easily imagine that 90+% of benefit that the SEC hopes to achieve is going to come out of those symbols. And the question, and most of the costs might come in a different set of symbols that just don't have the liquidity to support a narrower trading increment. So starting there, I think would be a big win for the SEC, it would be a big win for the industry, and it would make sure that MET's trading costs aren't actually being increased as a result of these changes, which I think is something they need to be more thoughtful about, because retail investors are not just participating as retail, right? They're participating through institutions that are managing their 401ks and things like that, and the SEC needs to pay attention to that.
I feel like Matt's going to agree with you on this.
Yeah, I mean, I couldn't have said it better, Adrian, but I will add a couple of things. One, a lot of obviously these proposals are designed to address retail type of activity. And as Adrian mentioned, the word balanced. I mean, there has to be balance in understanding how you can have deleterious effects to institutional activity by instituting some of the proposal the way it is. So the way I look at it, I'm like, first of all, I don't see a yardstick here. I need a benchmark. I need goalposts that are clear and definable. So first and foremost, if I were drafting this, I'd put, whether it's 605, whether it's some other transparency initiative, we have to put data out that creates that benchmark. And then we can start introducing different aspects of the proposal, whether it's round lots, whether it's tick reform, whether it's access fees, whatever it might be, because then we can measure what the baseline looks like and what those effective changes have done. What the SEC is looking to do is obviously introduce 4 or 5 different things simultaneously. One, we have no idea what that would look like in a market currently. They're introducing things that don't exist currently. That's what's, even when you look at access fees, it's one thing when people say, hey, let's take the tick down to a half and we'll take the access fee down commensurately. That's one thing. It's another thing when you say, hey, the access fee might be half the tick. We have no idea what that's going to do for liquidity. We have no idea what that's going to do for different market participants, how they're going to react to that, how they might take advantage of it, how they may be hurt by it. We don't know. And so why not take the iterative approach of introducing things individually? And if you want to get there, I'm all on board with what Adrian was saying. Study the data. If it looks like you implement A and A seems to do what is intended, then you can implement B and C and D, and you can get narrower. You can introduce access fees that are tighter. You can do a lot of different things because then we can measure it and we can identify what those changes are doing. So that would be how I would introduce this. I'm a little surprised at how aggressive the SEC had been in introducing so many different variables all together, which basically makes measuring anything impossible.
This is the kind of feedback that I think would just, from a regulatory perspective, would have been very beneficial for them to get I'm sure they got a lot of this feedback informally, but to do so in a more public, formal way, I think would have been really beneficial to the SEC's process. So they're doing it now. We're 3 months past the time that these were proposed, and we're 3 weeks away from comment letter deadlines, and I'm sure they'll keep coming in after the fact. One thing that we're all seeing, I'm sure, is a coalescence around a couple of ideas specific to tick sizes. We'll just stick with that for the time being. I think let's assume full agreement with everything that both Adrian and Matt have said thus far, in particular around the process and rolling this out more slowly. But I think we're also starting to see a general acceptance for the fact that there needs to be some tiering of tick sizes. A strong view that that a tenth of a penny and even 2/10 of a penny is probably way too granular of an increment for a number of reasons. I think from an institutional perspective, Matt, you have better experience with this than I, but I think it certainly creates more noise in the marketplace. It creates the opportunity for penny jumping by an economically insignificant amount of money. This isn't new. All of this was debated back when Reg NMS was passed in 2005, and that's why we landed at pennies in the first place. But in addition to that, you're leaking a lot of information into the marketplace, and importantly, you're creating an excessive valuation to the prop data feeds. With the finer the increment, the more market data you're producing, and therefore the more important those proprietary data feeds become. And isn't that really contra to the whole spirit behind everything the SEC was doing in 2020 by bolstering the SIP and making it a more competitive product? So it seems to me we're moving in the wrong direction, especially the more granular you go. Whether it's the NYSE, Citadel, Schwab letter that was just posted to the SEC's website, or certainly NASDAQ has been writing on their intelligent tick proposal for years, frankly, and I think now have a simplified version of that. Other exchanges, Adrian, I know you've done a lot of work on this. Seems to be a general consensus forming around. Let's start with half a penny for tick constrained names. There is a question then whether, for the sake of symmetry, whether you move to wider tick increments for your less liquid names, right? And look at and I think that's something that we could probably get behind. In fact, we were publishing on that back in 2010 in our concept release on in our comment letter on the SEC's concept release in 2010 on equity market structure. So there's a number of different grades, but certainly starting at no less than half a penny seems to be where the bulk of comments thus far have really been aggregating.
You know, it's funny because I thought we were going to spend most of our time talking about the order competition rule, and we're sort of tap dancing around that a little bit. But I would love to dive into that as well too. The chair at Larry's event last week, you know, stressed he was really trying to level the playing field, right? And I'm just, based on conversations that I'm having, or based on things that I'm hearing from the buy and the sell side, it seems like potentially starting sort of with a false premise there. Do we believe that's the right place to start? I know, like, how could you be against the level playing field, right? I mean, how can anybody be against that, you know, on first pass? But is that the right place for the industry to sort of be viewing this, or through the right lens?
Yeah,
I mean,
I
almost
can,
okay. Go ahead, Adrian.
Oh, sorry, Mike. Yeah, no, I can start off on this one. At first, I feel like I have to give the mandatory disclaimer that we all hate that set of words, right? Leveling the playing field is really just an abstraction, right? You know, if you say, should the playing field be level? Yes, but what do you really mean by that? I think that's the question. You know, I remember a speech by the chair. I think he was talking about SPACs, and he said, you know, it's about treating like things alike. Which leads to two questions: what are like things, and what does it mean to treat them alike? So, you know, when we talk about you know, leveling the playing field on ticks, what the SEC proposed to do is to treat quoting and trading increments the same. And I would argue that, first of all, those are not like things, right? When we talk about the trading increment as distinct from the quoting increment, what we're really talking about is, you know, the level of price improvement or the granularity of price improvement that you're allowed to give to retail investors. And when you talk about the quoting increment, what you're talking about is, you know, what makes it onto, you know, lit exchange order books to establish the MBBO in those names. And those are two very, very different things. Now, if we want to focus on what I think the SEC is looking at from a goal perspective, I think their goal is to make exchanges and off-exchange venues better able to compete for retail order flow. And it's true that today we have different increments that apply to retail order flow, depending on the venue. But you don't have to make those, you know, you don't have to harmonize quoting and trading increments to make those things more similar. I think, you know, instead the SEC should actually be thinking about harmonizing things in the opposite direction. So you've got, you know, retail liquidity programs on different exchanges. Is there a reason why those have to be either, you know, at a penny increment or go through, you know, an exemption process to trade in, say, 3 decimals? Or, you know, is there a reason why those shouldn't be allowed to be displayed? I think the answer to those questions is no. And, you know, there are things that you can do on the exchange side or the ATS side that increases our flexibility to trade retail, that don't, you know, result in some of the things that we would see from, you know, the SEC's proposal. The chief one, I think, being is that 1/10 of a penny, for example. I think that actually flows from harmonization, right? That flows from wanting to have pricing increments within the spread. And you need to pick a number that's low enough to support retail trading, but that number is not what's going to be helpful for, you know, T-row prices of the world. And I think we need to think about that, but harmonizing in the other direction would be beneficial, I think. And that's where I think the SEC should focus.
You guys have
Yeah, you know, look, I was just going to say that I think that the concept of leveling the playing field, or that phrase, is just so misleading and I think you know, damaging to an industry. There is no more competitive market that I am aware of than the market for U.S. retail order flow. It is as competitive as it gets. We were, said he was a market maker in that business for a decade, and I can say with firsthand knowledge that is, it's tip of the spear in terms of just the level of execution quality, because these are firms that are, if you don't earn it every day, you're not getting that flow. So to say that it's not a level playing field, I think is a misnomer. There are things that we could do, the idea right now, both market makers and exchanges can quote in sub-pennies. And so if we're looking at a harmonized approach, I think the NYSE Citadel Schwab letter did a nice job of massaging this. Move to sub-pennies for your tick constrained names, and then harmonize down to a tenth of a penny increments to allow a meaningful level of price improvement to continue. And there's no reason really why the quoting and the trading increment need to be the same. So whether or not you necessarily agree with that approach, certainly there are things we can do to make NMS kind of work for both exchanges and wholesalers. But let's just put an end to this idea that it's not a level playing field. I think it's unfortunate to say that, because it does a disservice. It's just not based in reality.
Matt, do you kind of agree? Do you think the buy side feels similar? Or
I'll speak on behalf of T Row. So certainly, yeah, the notion of leveling the playing field is one that it's nice. It's a nice saying. Gets a lot of people behind it. I think it's impractical because, so they're looking at the retail space now and saying, well, how do we get more retail flow away from the wholesaler? Let's take elements of some of what I guess drives that order flow that way and try to put it on an exchange, and that'll level things out. What they're not looking at is the complexity of that process and the other intangibles that drive that wholesale experience. So I don't care what you're doing from a price standpoint on exchange, you still can't principally price anything. They don't have that capacity, they never will. You do not have order size benefits that could be obviously provided by a wholesaler. There are lots of other things that a wholesaler provides that gives that total experience to retail, that if you try to just take pieces of it and say, well, we'll just narrow the tick and we'll force you to go here, that levels everyone out. We're good to go. And they're missing the point of that. I don't think it levels anything. I think you obviously make some things within the two platforms similar, or the two venues similar, but the experience is still going to exist in a positive manner somewhere else because of all the other factors that are involved. So it's cute. It's nice to say, let's level the playing field, let them compete. I mean, if the exchanges truly want to compete, why don't we enhance the RLP programs that exist out there? Instead of mandating, and you brought up the order competition rule, instead of mandating that someone have to take order flow to an auction essentially, why not make the RLP programs more robust? Whatever is, I guess, identified as causing them to not be, part of the process currently for retail order flow, let's enhance that. Let's make that a better process so that when it comes down to it, that broker can say, hey, I might get a similar experience if I go to X or to Y, and let me make that choice, instead of the SEC kind of directing them to do so because they feel that it levels the playing field.
Right.
Matt alluded to this earlier, and that is, remember, so much of this stems from a particular moment in time, two plus years ago now, where we were in the midst of the meme stock frenzy. We were the GameStop report came out and didn't really have any definitive recommendations, but drew a few conclusions. And there was a genuine concern about the level of off-exchange trading, in large part prompted by a pretty significant increase in retail activity in the marketplace. How many years have we been asking the same question? What is the appropriate level of on versus off exchange trading? And nobody ever has the right answer to that question. But certainly for many people, when you get more than 50% of particular names trading off exchange, you do start to worry about what that means from a public price discovery standpoint. And so, and correspondingly at the same time, you've got, 75% of retail orders in this country being executed by two firms and maybe more. So there's nothing inherently wrong with any of those stats, but that is the environment that kind of prompted the SEC to move in this direction. So if you want to have the effect of bringing more flow off exchange back onto exchange, then this is what you're going to get. You're going to get a series of proposals that are very heavy-handed and are trying to effectuate an aim. And if we need, a soundbite to get us there, we're going to say it's all in the name of leveling the playing field. That's why it's so incumbent upon the industry at this point to really engage with the SEC in a very constructive way, supporting that which we think we can support, and opposing that which we need to oppose, but importantly, making recommendations for how better to do things. I think the idea that many people have that we'll just, we don't like any of this, so we're just going to oppose it all. I think it's just naive to think that Gary Gensler is walking away from these things. And B, I think maybe putting an overemphasis or maybe too much optimism in the legal process. If you think that, just suing the SEC over these after they're approved, you're guaranteed to win because it won't withstand a cost benefit analysis. Once things get to the courts, anything can happen. So I think at this early stage of the process, as an industry, I believe we should all be constructive in our comments and look to make recommendations rather than just throw darts.
Yeah, can I jump in real quick, because Mike said a few things I want to elaborate on. First of all, there's this notion that dark trading is bad trading. And I've heard this from the chair where he conflates issues around the lack of transparency in other parts of the market has led to some negative outcomes. And he looks at dark as being not transparent, and therefore it's negative. And so that's a bad way, obviously, from an institutional perspective. We trade a lot, both on and off exchange. There are reasons why we go to different venues at different times. Saying that one of those venues is particularly not good for the market just completely is ridiculous, frankly. People should have a choice of where they want to go and how they want to get there. So, kind of putting these rules in place. And by the way, this extends to what the best X rule looks like as well. If I want to have a choice, particularly about the type of venues I want to interact with for my customers, because I've done the work to determine that those are the appropriate venues for me to go to, it is not necessarily required for me to have to connect everywhere and have to go and evidence that those other venues are not better or giving me a better experience. So I don't like that notion. The second thing is the percentage off exchange could be negative. That would be the case if we only solely relied on an NBBO, but we don't. Everything that trades goes to the tape. Everyone sees all the volume hit the tape. That last sale number is much more important to price discovery than people give it credit for. Because I'll tell you, I could care less what the NBBO is for a particular stock that has 100 shares aside. I care more about the 10,000 share print that just went off at a particular price point, because I think that sets that price discovery a lot more than someone quoting 100 shares. And if you fast forward to what the SEC is proposing, the NBBO is going to become even less relevant, because we're going to have round lots that are narrow, smaller in size. We're going to have ticks that are smaller, and you're going to have basically small size quoted in small increments. That's not price discovery, folks, especially for institutional firms. Last sale is going to be so much more of a driver of that. And that happens regardless of whether it takes place on or off exchange. So that narrative around dark being bad, too much dark trading leading to a lack of price discovery, it's a bad narrative. We got to move away from that.
Do you think like an end result basically could be sort of a meaningless public quote that nobody pays attention to anymore?
From an institutional perspective, absolutely. It becomes something that I can't use. What's the benefit of me of seeing 10 shares by 10 shares on a 20 mil spread when I have to trade 1 million shares of stock? Why does that matter?
Sure. Yeah. Something else, and I don't want to put you too much on the spot, but that comes up, it's coming up more and more in conversations with the buy side. They're kind of throwing up their hands a little bit and saying, well, hang on a second, like who said I even want to interact with retail in a lit auction these days, right? It's one thing to, and they're not saying they don't, or the conversations that I've had, I want to be clear about this. It's sort of like, well, we're not saying we are, we're not saying we're not, but who's saying that that this is of interest to us. It's one thing to sort of post in the dark. It's another thing to interact with a lit quote. I guess speaking, for yourself or for Tiro and what you can, like, how do you feel about that?
Well, you're certainly not going to help my voice in any manner by
I'm
making me
sorry.
speak as much as I am, but why not? I'll give it a go.
Yeah.
So from our perspective, obviously, we're not opposed to interacting with retail liquidity. Certainly, it's probably good interaction more often than it's not. I don't know how juicy it is, as Chair Gensler likes to call it, but there are times where certainly interacting with retail is beneficial. There are times where interacting with retail is not beneficial. And, when he says, and he said it the other day at the Bloomberg conference, where he said, hey, there's nothing else behind that order. That's not necessarily true when you see what happens with meme stocks. So, that used to be the sentiment, certainly 10, 15 years ago, because when you interacted with a retail order, it genuinely was probably an individual order coming in a particular ticker where it had no correlation to any other orders coming in. That correlation has grown significantly. So right off the top, every retail interaction is not necessarily a beneficial interaction. Second, it's the way that it's constructed, as you said. So when you send these orders to an auction, that's all well and good, but you're publicly disseminating a held order to the marketplace. And, there's been this idea of doing auctions previously around a continuous market, what that would do. And that wasn't supposed to be out loud. And, there's a continuous market effect, obviously the pricing of the auction. Can you imagine there being indications to the marketplace that someone who's held is now coming in to buy a security or sell a security, and some of the parameters of their order flow, and there's a continuous market now reacting to that information? That's insane that the SEC thinks that's a good idea, frankly. Now, let's put that aside. You have a whole bunch of really sophisticated market participants who are going to react to said auctions, including potentially some institutions who may or may not be able to be as sophisticated when they're responding. My one concern is, depending on when we do or don't, are we always winning when nobody else wants to interact? And in that case, I wouldn't say we're winning at all. It seems like we're the last person standing. So again, that interaction may not be necessarily the best one. And then on top of that, obviously, if you're trading very liquid names, there's going to be enough robust participation that you shouldn't have any problem with being ambiguous and who's interacting and who's not. When you get into very illiquid names, and I know retail doesn't necessarily navigate in those names that frequently, but when there's interest from a retail participant to say buy 2,000 shares of XYZ, and let's say XYZ is not liquid, the responder to that, and especially if that responder comes in multiple little iterations, can be somewhat determined, right? If it's smaller in size, maybe you can assume it's a market maker. If it's larger in size, you might assume that an institution is now on the other side of that trade, because it may not be something a market maker wants to take down. That's a lot of information leakage to the public, because they know, it was a retail order. They know market maker may not have wanted to do that kind of size. And so you come in now and you're giving up the fact that institutions are doing a certain thing. That's a terrible outcome for us. So when I say I don't want to interact with retail, I don't mean it like, hey, I never want to interact with retail liquidity. I want to interact with retail liquidity when it's beneficial for me to interact with retail liquidity. And that doesn't necessarily mean that institutions will always be that backstop that the SEC envisions, or anyone else for that matter is that backstop that the SEC envisions.
Right. It sounds like what you're saying is institutions don't like being run over, right? And they're not they're not market makers.
I could have saved my voice if you would have just led with that, but yes.
But I love hearing you talk. That's why I do this.
I mean,
all right,
Matt, Matt, I think that I love what you just, what you just described. And I think that was extremely clear. I think it's also one of the reasons I don't spend a ton of time on these retail auctions and discussing this either internally or with clients is simply because of the 4 proposals, I give this the least likelihood of actually passing in its current form. I think for a whole host of reasons, it's going to get hammered during this comment process, as we all know. And it's going, and if the SEC, I think is audacious enough to adopt it as is, then I think the likelihood of suit is very, very high. And in this particular case, just based on the Administrative Procedures Act, I could see this one getting struck down by the courts. But that again, those are all much later innings types of things. But one thing that really concerns me about the auctions, to kind of complement what Matt has described, I would argue that even in some of these very illiquid names, there's a strong likelihood, danger that the market makers won't even be there, because that whole cross subsidization that exists today under venue by venue competition, which again, this is nothing new. This was all debated back in 2005 with NMS, and they opted to move in the direction of venue by venue as opposed to order by order. And one of the results of that is, as a market maker, you are responsible for execution across the board. You get a basket of securities. Some are really liquid, some are not, and you're making markets in all of them. And now, if my obligation is only to be there for those orders on which my models tell me I can make money, then I worry about what that means for the less liquid segment of the marketplace. And again, isn't this totally antithetical to what the SEC was looking at just a few years ago? The previous SEC administration had 3 major areas of focus. It was market data, it was investor fraud, and it was thinly traded names. And now here we are doing something that I think is going to have a negative impact on thinly traded names. And I'm not sure that's getting a lot of attention.
Yeah, I mean, the assumption here that there's, any one market structure that works for, some segment of order flow is just wrong, right? That's not how institutions trade. Look, if qualified auctions in something similar to that form work for, some names that are very liquid, where they could produce, okay results, I think we could still have a question of, is okay better or is okay the same? But sure, they could work for some names. I think they're not going to work for some names or in some situations. And just the idea that you have, one market structure, and you're going to say, well, this is it, guys. We've solved it. We don't need to think about anything else. I think that's just wrong. I mean, if you look at the best X rule as an example, right? The SEC there is saying to brokers, look, you need to assess data. You need to decide which venues give you good execution quality, and then you need to make decisions about where to route your orders, right? And it's a very data-driven process at the end of the day. And it can really conflicts with the way that they're looking at the order competition rule, because here they're saying, here's a venue that we've designed. It's never been tested. Nobody has data on, what orders might be benefited by qualified auctions, because nobody's created one of these auctions. But they're saying, forget about the data. It's, this is it. It's the best, and you should send your order flow there. And that just doesn't make any sense. The way that we think about this is let venues innovate. So if somebody wants to run an auction, they can run it. We can see what the execution quality looks like. If it's good, brokers will have an obligation under Best X to send order flow there. If it doesn't work, then we'll move on to the next solution. And you don't need the regulator to define what the venue looks like, and you don't need the regulator to force brokers to use that venue. I think what you really need is flexibility, right? And I'll make this point now. We have a retail program that we wanted to implement. It was a midpoint program. We had a lot of firms that were interested in this, from a broker perspective, market maker, institutional perspective, and the SEC disapproved that program. Just very quickly, the way that this was designed to operate, we would collect orders that are willing to trade only with retail counterparties. We would send out a flag when those orders, and those are all midpoint orders, we would send out a flag when there are orders available to trade with retail. And if you have a flag that says, hey, we've got liquidity here at the midpoint. If you're a broker and you have retail order flow, and you're potentially looking at an execution that is worse than the midpoint, then you really have, an obligation to consider this venue that's telling you that there's, midpoint liquidity available. This is actually one of the problems that the SEC identifies in its discussion of the order competition rule, which is, it's a coordination problem, right? They're seeing executions go off worse than the midpoint when CAT data is telling them that actually, ATS XYZ has a midpoint order available there. And our program would actually allow you to solve that coordination problem and potentially get some better executions out of that. And the staff disapproved it. The reason that they gave for disapproving it was they thought that we wanted to give priority to these liquidity providing orders that light up our indicator and attract the other side of the trade. And they basically said, no, you can't do that. You actually have to give equal priority to midpoint peg orders that are sitting on your order book. Now, funnily enough, order competition rule has about 5 different priority requirements. One of those requirements is that auction responses go ahead of non-displayed continuous book orders, right? The exact same thing that they told us we couldn't do, it's in the order competition rule. Meanwhile, this was all about a year ago, and we haven't been able to launch this program. Our tech team has a lot of things that they're working on these days. We've got options coming. We've been building a crypto market for EDX, but we could have launched this thing a year ago, and we could have been, getting better execution quality for retail investors. And I have no idea, how they rationalize, what they've done as far as disapproving our program while simultaneously, proposing to do basically the same thing from a priority perspective. And really, I feel like we need to allow venues to innovate, and that's what's lacking right now is, the SEC is thinking about this from the perspective of how do we design the right market structure for everyone? And I would kind of reframe that question as how do you allow market participants to innovate and create the best market structure for themselves? And that is something that I think the SEC really needs to think about.
Yeah, two things I want to chime in here if I can too, and just I want to start being mindful of time because I do tend to ramble, right? But I'm personally worried about actually the retail trading experience here, because back in, I believe it was the Great Return, the STA Market Structure Conference of 2021, I believe, where Tal Cohen, we kind of stressed that we really need to protect the retail experience because it's such a significant part of the market. And I'm sort of paraphrasing here, but if retail starts feeling like it's not fair and open, they're going to disappear. And then we have a much bigger issue because once they go away, they don't come back. And I look at potentially, or what I'm hearing, I should say, that it's not going to take very long for some retail to kind of look and say, well, wait, this is an unfair auction process now. Who said this is fair or open? The unintended consequences, right? Now, I learned in 7th grade algebra, you can't change 2 variables at once and kind of measure for it. And it just seems like a massive risk. And proposals are supposed to make things less risky and mitigate that risk. My fear, retail has a bad experience, goes away, and it takes a lot of time and effort to get them back. I don't know. Maybe I'm crazy if you guys have that, that similar concern.
No, I think.
Sorry, if you don't mind, I'll jump in real quick. We share very similar concerns around that, especially in less liquid names, particularly small cap names, because right now retail gets a very similar experience, whether they're trading, a large cap, mega cap name to a small cap name. In the future, they're not going to get that similar experience if the SEC proposals go in as they are constructed, because when it comes again to Apple, I'm sure there's going to be a robust market, lots of market participants. Everyone's going to be okay interacting. When it comes to a very illiquid name, let's run through that process. Wholesaler doesn't want to fill it at mid. It gets sent out loud to an auction. Nobody comes in to fill the other side. All of the FAR quotes are now fading because everybody knows that there's a buy order in, all offers are gone. The market widens, and now you've told this retail person they have to aggress the market, which they have no comprehension of depth. There's no depth in any of the information they see currently. And now they're going to get a price that's not only far away from what they saw on screen, but not explainable to them when you go through that iteration that I just went through. So eventually they stop trading in small cap or less liquid names. It's just not going to be a favorable experience. And so that hurts folks like T Rowe, where we need robust, lots of different market participants, all trafficking in similar names because liquidity is important. I don't care if it's coming from, a retail mom and pop shop, a market maker, a hedge fund, whatever it might be. I need lots of different industry participants providing liquidity when they can. And so if we discourage both market makers to not have to be obligated to make markets in small cap names, and then we discourage retail participants to not trade those names because they're getting bad outcomes, who's left?
Yeah. So we've got a couple of questions come in around the best X role, and I do want to chat about that for a second too. Just camp out there for a minute. One of the things that I'm hearing, particularly from the small, mid-sized broker dealers, though from the buy side as well, and some of the larger ones, is that when they look at things like the best X rule, and even sort of pairing it with 605, it starts getting a little miffy, or there's a fear that we're kind of going down that path where they're going to have to start, maybe justifying why they're going to low fee venues or certain routing strategies, why they missed the print. And Matt, you kind of touched upon this earlier, at a lower volume, but maybe, unique liquidity venue. So the question, sorry to make you keep on talking, but somebody's asking about, how are you thinking about that, on the buy side from a, compliance legal sort of perspective?
So as everybody on this webinar knows, I'm a huge fan of MiFID II, because I thought that was proposed and implemented fantastically.
Awesome. So good.
Yeah. If you think about what happened in Europe there, again, a lot of that was driven by the fact that they wanted to pull liquidity from off exchange venues back on exchange. So they, under the guise of, hey, this additional transparency, whether it's these reports that show where brokers go, or where the institutionals route their orders to, let's implement that. And at the same time, let's implement a significant amount of changes to the marketplace. We eliminate broker crossing networks. We put in double volume caps. We institute a whole bunch of other stuff that doesn't really make sense in order to drive an intended change that we don't necessarily want to explain. What was the outcome? I don't think it had the intended outcome that the regulators were looking for. Why? And it goes to this point on these proposals. Well, there is not enough people that give credit to market participants. Regulators don't give enough credit to market participants in how innovative they are, especially when they're competitive. When it comes to their business, they will find solutions to proposals. So that's what you saw in MiFID, and you saw a lot of people migrate flow, again, not necessarily on exchange, but to other venues because they found language that they can kind of utilize. And the same thing's going to happen here. So this notion that if you force things upon people, that they're going to have to follow it, let us innovate, let us find solutions instead of kind of prescriptively telling us what the right thing is, and then having us kind of avert, and find other solutions ourselves, trying to distinguish between the rules as they are or as they're interpreted. I'm not a fan of the best X rule. I've never been a fan of OPR. OPR requires you to have to connect to every single exchange. This best X rule essentially requires you to connect to every single venue. It's absolutely crazy and by the way, Adrian gave a phenomenal example about how sometimes there's contradictory things happening between SEC speak and SEC proposals. I know one of the tenets of why they've proposed this is around competition. I don't see how smaller firms can continue to be competitive in this environment when now you're asking them to connect everywhere, to bear the burden of more cost to evidence best X, to produce 605 reports. So this notion of competition doesn't certainly extend to market participants. It only extends to let other venues compete for retail flow. So no, not a fan of best X. And I'm worried that while it looks still, policy oriented, not policy oriented, but philosophically oriented for the buy side, it's very close to being prescriptive for us as well. And I'm nervous that the SEC can take that leap forward very easily and say, hey, what's good for retail is also good for institutions and other brokers. And we want them to abide by conflicted transactions, which would obviously be significant for us from a principal perspective. Abide by connecting to and evidencing that you're going to every single venue, which would obviously be costly to our brokers, costly to other market participants. So yeah, I'm not a huge fan of this. And then lo and behold, by the way, we have two competing best execution rules. We have the FINRA rules, we have the SEC rules. Which one does someone have to abide by? Are you going to get penalized twice if you're not doing something within the guidelines of both those rules? It doesn't make any sense.
Well, next time you're going to have to come back and tell us what you really think. So
Did I tell you how much I like MiFID?
we love MiFID. We love it. Love it. You know, it's funny because one other thing, and then we got to wrap this up. But one other thing that come up a little bit that's been on my mind, and you hinted at it too, the smaller broker dealers would, you know, potentially be more disparately impacted. And if I think about what's going on in their world, my former world, there's so much, not necessarily in a bad way, but so much outsourcing, of lack of a better word, of algo stacks, market connectivity to some third-party aggregators. And you know, my fear is that are these small and mid-sized broker dealers going to be sort of forced to use more generic routing strategies? What does that do to innovation overall? They're generally the ones that seem to, you know, be leading the innovation on that front. So that's something on my mind. One other question that came in, and I'm gonna use this. Just pull Adrian back in here for a second. So last week at Larry's conference, in the chair's closing comments, I'm quoting here, he basically said institutional community's feedback is welcome, but it won't influence his decisions because broker exchange and mutual fund profitability is not his issue. Adrian, any kind of thoughts on that as we wrap up here?
Yeah, look, I mean, and honestly, I didn't actually get to watch the chair speak last week, but that's an odd comment. I will say, you know, the SEC's mission is to protect investors, and that means all investors, frankly. And if the SEC is only really looking at this from a retail perspective, which I think is what's reflected in the proposals, that's just not the right way to go about things, right? We need to protect all investors, and frankly, I think the part that often gets missed is we're talking about the same people, right? Like John Smith, who, you know, has a retail brokerage account and that the SEC wants to protect, also has a 401k, and he probably has more money in that 401k. And so, you know, if you're talking about increasing the costs on that side of the market, you're potentially hurting American savers more than you're helping them. So I think we need to be broad in terms of who we're trying to protect. And also, you know, I think we need to also think about the impacts on all of the different classes of market participants, because, you know, like even if you're talking about, you know, making, like, say you're increasing costs for small broker dealers and you say, well, I don't care about that because those are not the constituents. Well, those small broker dealers are also, you know, handling order flow on behalf of, you know, the constituents that the SEC is talking about. And so we need to be very thoughtful about, you know, how we approach these changes. You know, profitability shouldn't be the SEC's concern, but, you know, how these changes impact the market overall absolutely has to be.
And Jesse,
last point on that.
Go ahead, Mike.
No, please.
I was just going to add real quick. There also have to be considered about issuers, because as we talk about that less liquid small cap universe, if you're not allowing those issuers to have a nice, robust secondary market, you're also disincentivizing them from going public. So issuer concerns, if there are any, are really something that the SEC should weigh heavily on, making sure that changes don't affect issuers, don't affect investors. And Adrian said it better than I could. I mean, we represent the 330 million people that Chair Gensler says he represents. They're invested in their retirements through T. Rowe Price and other asset managers. So I know he thinks we're conflicted, but the best interest of T. Rowe is also the best interest of those 330 million people.
Right. Michael, any sort of parting thoughts here?
I noted after the conference that part of the conference was actually televised more broadly. So it wasn't as though he was just speaking to our industry. I think he was speaking to a broader, mom and pop investors with whom that message may resound. Like, you've got an SEC chair who is myopically focused on just retail investors and doesn't care about the industry profitability. It sounds great. That's a great message. That the flaw in that argument is that the industry, I think this is why it gets so personal for so many of us. We're not, most of us in this business are not out to just make money at all costs and screw retail investors. I think that idea is really insulting to a lot of people, and I think that's the premise behind the question that was asked. Gary Gensler will do what he needs to, what he believes he needs to do as chair of the SEC, and that's his prerogative. He does not necessarily have the ability to just ignore. I think that statement has gotten misconstrued. He doesn't have the ability to just ignore the industry. The industry's participation in this process is required by law. It's part of the Administrative Procedures Act, and we all know that. And that's why I just would reiterate the importance of people getting involved in this debate constructively at this stage.
Yeah, absolutely. All right, well, on that note, we are at time. I feel like we could talk for a few more hours, but maybe we'll save that next time, and Matt can't talk for a few more hours. He's done. Matt, when your throat heals, we'll come back. We'll dive into more MiFID. Maybe we can even touch upon the SEC's no action letter that's expiring this summer, because everybody's clearly well prepared for that. So guys, thank you so much for participating here. Everybody who's watching online, listening online, thank you for joining. It really means a lot to me personally. It means a lot to us here at Coalition Greenwich. It means a lot to the three guys here. We're going to have a replay available, I believe, early next week. For those of you in the tri-state area, enjoy the afternoon. It looks gorgeous outside. And until next time, thank you, everybody.
Thank you.
Thanks.